ARPA-E's objective, as it's stated, is developing and deploying disruptive technologies. So Arun Majumdar moved out to DC in 2009 after being a deputy director at Lawrence Berkeley Laboratory and being an engineering professor for decades. And within his first month of being in DC, he was kind of put through the ropes and brought up to the Hill to talk to a bunch of congressional members about ARPA-E. So the briefing went very well, started off very well with him talking about all of the great stuff that you guys are doing, until he used the words deploying disruptive technologies, a term that's pretty common for a lot of scientists, certainly for business people, disruptive technologies. But disruptive technologies, for folks on the Hill, was synonymous with destructive. And so kind of the red bell, the alarm started ringing, the red flags were raised, and an onslaught of questions started coming at him. And so Arun very quickly learned to use things like game-changing and breakthrough technologies rather than disruptive, i.e., he learned rule number 1, which is you need to understand your audience and how they see the world. Otherwise, you risk talking past them and not being able to seize an opportunity. So today's panel on demystifying capital is essentially talking about how do financiers see the world. And we have Matthew Nordan from Venrock Capital here to help in translating how capital providers think and speak. Specifically, he will discuss some of the nuances of each of the subcultures of capital providers. What are the similarities? What are the differences between how angel investors, venture capitalists, private equity firms, commercial banks see energy technology, and as a result, when and how should you, as a technologist, utilize and talk to each one of them. And I can't think of a better person to talk through this than Matt. He's a vice president at Venrock Capital, which is a premier VC firm. I'm sure many of you are familiar with it. It is the Rockefeller family's venture arm. However, Matt is actually pretty new to the VC world, having spent more than 10 years focused on science-driven innovation. And he's been very successful in the energy finance world because he's become a really great translator between technology, finance, and markets. So join me in welcoming Matt.
Hey, everybody. Very good to see you all here. I am indeed Matthew Nordan. I do indeed hail from Venrock. Our firm has been backing energy innovators in the U.S. for literally decades, going back to the first lithium-based battery in 1977 on the first big geothermal energy producer in 1980. But I've only been in this line of work for about 2 years. Now, that's long enough to understand how it works from the inside out. It is not so long, thankfully for this presentation, to have lost one's sense of ironic detachment. So I hope that today I can speak to you as much from the perspective of a VC as from my previous life, where with very talented co-founders, I co-founded and led a startup company, an information services company, and a true startup. The kind where you come home to your spouse and say, honey, I know we've got that mortgage and the second baby's on the way, but I am going to take a huge pay cut. And I hope you don't like dental insurance, because we're not going to have it. It's okay to laugh. Laughing's good. Here we go. Rise up with laughter. So I thought that we could have a good discussion today about different forms of finance that you can use to take your technology and build it into a world-beating startup. But I also thought that we could just play the Legend of Zelda, because there are actually some astonishing parallels between the two. You're in a poorly understood environment. You don't have a lot of direction. It can be frustrating if you've done it before, but it can be something more like inscrutable if you never have. You keep coming up against bigger and bigger challenges, and when you face them, the things that have served you well in the past just don't seem to work. And the issue is not that you don't have tools available to you. You have tons of tools. The trick is being able to pick the right one that gets the desired effect, which is not always obvious. It's not until you're able to size the situation up and understand what you're up against that you can make the right choice, and then when you deploy it, you can get a little closer to your goal. So with that in mind, let's dive into it. There's one point I want to get to before we dive through each source of capital, and that is to be confident in yourself. I wish somebody would have told me up front when I started doing this, because I had this conception, this stereotype, that financial types were invisible superheroes from outer space, somehow capable of something I was not. And I'll tell you, at every turn, that illusion has been shattered. The truth is, fragile humans are all the world can hold. And when you're up against someone else on the other side of a boardroom table who seems to have more power or influence than you, you need to get inside that head and always see the world from the other person's point of view. When you do that, you can understand what motivates them, you can understand where their weak points are, and you're much more likely to achieve your goal in the end. So we need a kind of structure for thinking about sources of finance, kind of like a tree of life. I'm going to use the tree of startup financing with three major branches: selling stock in your company, equity, having somebody pay you to sell them something or do something for them, revenue, and then all forms of debt, which is fairly self-explanatory. You're going to hear as a theme throughout this talk, none of these things are good or bad. None is better or worse than the other. They're all just either purpose-suited or not, and they have different trade-offs. Now, at a macro level, before we dive into each, you can think about the trade-offs this way. We've got these three forms of financing. You can think about whether they are dilutive, whether they are delayed, you can't access them until later than you'd like, or they distract you from your mission, and then whether you have to pay the money back. Now, all these terms should be obvious except possibly dilution. Dilution is giving up part of the pie for a size of pie trade-off. So if you and I start a startup company, you own half and I own half, and we have to go out and raise $5 million from somebody, and we're going to sell him or her 20% of the company, well, we now own 40%, so we were diluted by the 20% that we sold to someone. Now, why on earth would you do that? Well, if we sold 20% of the company for $5 million, how much does that imply it's worth? Thank you. $25 million. That's right. The only reason we would do this is if getting that money caused the size of the pie to get much bigger than $25 million. It would enable us to be able to have the right trade-off in having a smaller slice of a bigger pie. So when you look at these three forms of financing, the downside of equity, of selling shares, is it's dilutive. However, you get the money right now, and you get it in order to execute exactly what's in your business plan. It shouldn't be distracting. You also don't have to pay it back. Revenue has a different trade-off. It's not dilutive, that's wonderful, but depending on its form, it either may only be available to you after you need it, or may distract you from your plan. You don't, however, have to pay it back. Then finally, there's debt, which, like the mortgage on your house, it's not dilutive to you. You get it right then, and once you get the money, you can use it for whatever you'd like. However, you do have to pay it back, and also, just like the mortgage on your house, if you can't pay it back, the bank takes your house. If you can't pay this back, the bank can take your business. So with that in mind, let's go through each of these in some detail. I'm going to start with equity, because I think there's a sort of default view that America has encouraged of entrepreneurs. And it is that if you want to build a big, successful, independent company, you have to take equity financing. Specifically, you have to take the institutional kind from professional investors like the firm that I work at. Right? When we think about Apple or Tesla Motors or Facebook, they all took institutional equity money, and in many cases, several hundreds of millions of dollars of it. However, this is wrong. There are plenty of other ways that you can build a successful, independent, even energy or environmental business. This data here is based on a set I had just available to me. It's showing you all the 65 companies that went public anywhere in the world at any valuation on a stock exchange in energy and environment from 95 through 07. And as you can see, only a little bit more than half of them raised institutional equity financing. The rest didn't. But you can see at the right the essential trade-off here. Those that did take equity financing from professional investors got to the finish line about 2 times as fast. And although I don't have the data, it's not quite as clean, so I haven't presented it here. As best I can tell, they also had about 2 times bigger valuation at the time they went public. So they had a smaller slice of the pie, but it was 2 times a bigger pie, and they got to eat it twice as early, right? So there are lots of sources for equity financing. I'm going to go through 4 of them. At a really high level, first and foremost is friends and family. You all probably have people in your networks who have access to some appreciable amount of money and might give it to you based on your personal relationship alone. The next is angel investors, generally retired executives from startups or corporate environments. They tend to invest in the tens of thousands to maybe the low millions on the basis of an early business plan. Next is venture capitalists, people like me. They tend to invest in the millions of dollars, up to maybe 20 million. That would be a very large check from one VC. Unlike the friends and family and the angels, venture capital investors aren't investing their own money. They're investing money from other people called limited partners, generally pension funds, foundations, and trusts, who give them the money and expect it back with profits in some time frame. And as a result, they have a higher burden of proof for making an investment. They don't want to see an early plan. They want to see a polished one. It should be accompanied, in most cases, by some proof of concept, whether it's experimental data or a prototype device. Then after that, there are growth equity investors. There are a lot of similarities here with the venture folks, but also some differences. One of them being size of check. $10 million would be a small check from a growth equity investor. $100 million is as high as they might go. And their key motivation is to invest in nothing with substantial risk. The product should already work. The customer should already be in place. The technology working is out of the question. It should be a foregone conclusion. People often talk about these sources of financing as early stage or late stage. The reason I've cut this down the middle of venture capital is that it's the most flexible box in this sequence. While growth equity investments are very stereotyped, angel investments are typical in size, VCs may make things that look more like one or more like the other. They have a broader continuum. Then finally, there is a time scale on this from the venture box outward. Friends and family angel investors, they're investing their own money. It's up to them, right, when that produces a return and how big that return is. But the venture capital and growth equity investors got their money from other sources who expect it back with profits in some time frame. And for the venture capitalists, 99% of the time, that's 10 years. They operate what are called 10-year closed-ended funds. So there's a clock ticking on the process, and if your company doesn't fit in a 10-year box, now is probably too early for you to take venture capital investment. So let's talk about each of these in turn in a bit more detail. If you want to understand how to get money from these folks, you need to understand the reward system. And we can start with friends and family. This actually would not be a bad family to get money from. Probably a lot of money, maybe easy to suspend disbelief. Could be a good choice. I will spend very little time on this. The key distinguishing factor of friends and family investors are that they're people who trust you implicitly and will invest for a non-financial reason, love, friendship, bragging rights that they've supported a buddy from college. The key thing to point out here is that when you negotiate, and it's really not negotiation, it's please give me some money, a friends and family investment, you're typically only talking about the amount invested, and you're not typically talking about what percentage of the company it buys. These investments are almost always done as what's called a convertible note. Now, if that's not a term you're familiar with, you're at the very beginning of just concept stage of a company, right? And I'm going to go to you there, the third in the front row, and I'm going to ask you for $50,000. How much of the company should that buy? I did not script him. It's too early to know, right? So a convertible note is a way of cheating. You're going to buy shares in the company, but you're not going to decide how many now. You're going to leave that until later when it's more clear how much the company is worth. So you use this when the valuation is impossible to agree on, usually very early, but sometimes later when the company's right in the middle, in between two milestones that would connote value. And a convertible note is a loan. Like most loans, it almost always has interest associated with it. And it converts into ownership of shares at some unspecified later time when money will be raised with a price attached to it. So to give you an example, let's say that in January of this year, I write you a $100K convertible note at 10% interest. January next year, you go out and raise money, you sell shares, maybe to a venture capital firm, you raise $2.2 million, including my note, that buys half the company, implying the company's worth $4.4 million. Now my convertible note converts into stock that's worth my $110K divided by $4.4 million equals 2.5% of the company. There's no feasible way we could have agreed on that at such an early stage. The second group of investors also tend to invest in the form of convertible notes. More often than not, they are angel investors. Angel investors are pretty diverse. For example, there's a group in Boston called Clean Energy Venture Group, a band of angels that is not only the most active group of angel investors in energy and environmental startups, but the most active investor, period, in terms of number of companies they invest in. Arunas Chisonis is a wealthy telecom executive who has put money into companies, particularly out of MIT. Bill Gates, you probably already know. While angel investors are kind of motivated by profit, they don't want to lose money. It tends to be more of a tertiary motivation. The primary one is that if you're a retired guy or gal, you want to have fun. And you can have fun on a yacht, you can have fun on a tennis court, but you can also have fun mentoring people at an earlier stage of their business life whose mission you're aligned with. And that tends to be the key motivation of angel investors. As a result, it follows that while it's sort of jacks are better, you've got to have a good idea and a good business plan to get their interest, their decision will probably be made more on chemistry with you and on personal alignment with your mission. When you negotiate an angel deal, the first sort of decision tree is, are you buying shares at a price or a convertible note? If shares, you'll decide about valuation. If a note, you'll decide about the term. But you'll also probably have a discount rate attached to it. Now, why is that? Imagine that you're an angel, you're investing a higher amount of money, you're a little bit more sophisticated investor. You know you're putting money in when there's less certainty about the business, and it's going to convert into ownership later when there's more certainty. You took more risk, right, by investing here rather than here. So you might say, I want a discount. So if the shares are going to cost $1, right, when my note converts, I want a 20% discount on that. Mine will be 80 cents. That's a very typical angel negotiation. Next on the list, let's go to the place I spend my life these days, which is in venture capital. I sat when I was preparing this and thought, how can I show these folks, what venture capitalists they might negotiate with are likely to look like? So I went to the websites of 5 prominent energy venture capital firms, and I took the headshots of all the partners and put them on the slides you're going to see, so you can see that statistically, you are most likely to be talking with a white male in a blue shirt. Right. Would like to get more diversity into this asset class. Venture capitalists, as mentioned, this is where we've crossed the dividing line from people investing their own money to professional investors investing other people's money. There are many kinds of VCs. Some focus only on energy, like Braemar. Others do the same and are very small and do more angel-like deals, like Terawatt Ventures. Others invest in healthcare and IT and all sorts of things, like more Davidow. There's no common previous career thread for VCs. You'll find ex-entrepreneurs and lifetime investors and ex-government people. What I do think is a connecting thread, because you're investing in things where you're sort of dreaming with your feet on the ground and envisioning what a business could look like far in the future, it tends to attract kind of eccentric people in one way or another. Some sort of rough edge, bombastic personality. Their motivation is primarily profit. There's some personal mission, but it's mostly profit. And in particular, being able to envision getting at least 10 times your money back on what you invest. And you might think for a minute, that's kind of crazy, right? You said these venture funds run 10-year funds. They're getting money from pension funds and others who would most likely put their money in the stock market, which returns 8% a year. You don't need to make 10 times your money back in 10 years to beat 8% return, right? You need like 2 times your money. Well, the problem is most of these investments fail. In a typical VC portfolio, half the investments return $0. They fail completely. 3 or 4 of them may do okay and return 1 times the money that was invested. Only maybe 1 or 2 will be big breakout successes. And when you jiggle all that math together to beat the stock market, you can't invest in anything where you can't envision at an early stage this 10x return. As a result, the key to the heart of a venture capitalist in a pitch meeting is being able to paint a picture of your business as a large, independent candidate for going public or being bought at a big valuation company that could achieve that 10 times return. If you can't articulate that when you're honest with yourself, then it's probably telling you something about your fundraising strategy and about needing to seek different vehicles. VCs are more professional investors. They will negotiate valuation with you. They will sometimes do convertible notes, but rarely. They'll negotiate about, do they have seats on the board, what votes are required for different changes in the business. Lastly, well, one other point on VCs. There are people who are not venture capital firms who nonetheless make investments with the same size, time frame, and return expectation as VCs. Sometimes these are corporations who make these investments so that they can get close to companies that they might want to acquire or partner with down the road, or more nefariously, to learn about a potential competitor. That's common. Second are family offices. So these are groups that invest only the money of one very wealthy family. That's how Venrock started out, as the family office for the Rockefeller family. Black Coral is a prominent one. The others, there are no logos because they tend to fly under the radar. They don't want 1,000 people knocking on the door with business plans. They want to carefully go out and select through their networks the ones they want to invest in. Madrone, for example, is the family office of the Walton family of Walmart fame. And finally, there are super angels, who are like angel investors, only more super, meaning that they can invest much larger sums of money over longer periods of time. The gentleman you see at the left there is J.R. Simplot, an Idaho potato billionaire, I'm not making this up, who independently backed Micron Technology in the semiconductor realm, and more recently almost solely backed Semileds, which went public in LED lighting about a year ago. Bill Gates, you probably know, Vulcan Capital is the super angel arm of Gates's Microsoft co-founder, Paul Allen, that is invested, for example, in nuclear technology. Super angels, you may find, will be willing to consider more technically aggressive speculative projects than conventional VC investors might. So, you know, I pointed out beforehand that as a venture capital investor, you are trying to place a value with a return expectation on a company that won't rise to publicly recognized prominence until much later. I liken it to trying to pick the NBA draft pick by watching 8th graders play basketball and then coming back in 8 years and seeing if you were right. Right? Now, the subject of study will change a lot between now and then, so you can't, you know, look at the 8th grade Kobe Bryant and think, what am I looking for? Is this the great player? You can only look for proxies, for latent brilliance that will emerge later on. And I think you'll find venture capitalists tend to think about 3 such proxies: technology, market, and team. It was interesting that the discussion beforehand went right down to these 3 in the earlier room. On technology, every domain has a learning curve where the price or performance of the existing solutions tend to be getting a little better every year. And if you're going to say you have, say, a 2x better advantage on some critical dimension, but you're going to be in market in 5 years, by the time you get there, your advantage may have been competed away. So as a result, venture capitalists look for a really big advantage now, and the dumb mental shortcut they will do is an order of magnitude better on some dimension. 10 times better price, 10 times better power density, 10 times better something else. Now, you guys are smart enough to know in many energy domains that's not relevant. In biofuels, I don't care what synthesis process you're using, you're not going to come up with 40-cent gasoline, right? But you need to be aware of this 10x bias, and if you can't find something in your pitch, right, that is better by an order of magnitude, you may be barking up the wrong tree. The same thing goes with market, where venture capitalists want to see a big market that could support a company with big revenues and be worth a really big valuation. The mental shortcut that's used often is it a $1 billion market? If it's less than that, then maybe that's a proxy for not being big enough. Now again, there are a lot of cases where that's not the right thinking. The market may be small now, it will be big later. It may be small now, but you can dominate all of it. Just be aware of the bias so you know which buttons to push. Then finally, there's the team. The first line there is repeated 3 times for a reason. The CEO of a company is that company encapsulated. And judgments by professional investors will be made about the entire company, broad, sweeping judgments based on very small interactions, you know, an hour or less with that CEO. If the CEO is late to the meeting, the company is disorganized. If the CEO is able to articulate points brilliantly, the company has amazing sales and marketing expertise. Again, it may not be right 100% of the time, but it's a good enough proxy to help folks make good decisions, and you should be aware of it and think very carefully about who you put at the front as the front man of the band designated as the business leader. Last category of equity to go to is growth equity. This, again, is professional investors investing other people's money, but with different contours. 2 good examples in energy would be Hudson Clean Energy Partners and Silver Lake Craftwork, Some venture firms have a growth equity arm. So Kleiner Perkins, for example, has a green growth fund that does only these kinds of investments. If VCs are best characterized as kind of advisors or business partners who happen to have a checkbook, they're not that sophisticated investors. Growth equity investors are the opposite. They are really people who are investors first and foremost, who happen to be doing that in technology or energy as a secondary point. They tend to be much heavier on numbers and on spreadsheets, and to do much deeper diligence on your company. They are playing the same game of trying to beat 8% stock market returns as the VCs, but if the VCs are trying to do that over 8 to 10 years with a 10x return that works out to the right annualized rate of return, these guys are trying to get 3x in 2 to 5 years. So smaller return, but shorter amount of time equals a similar internal rate of return. And as you can imagine, you're not going to see that return in that amount of time unless you're investing in a business that is all down to execution, where the technology works and the customers are there. Growth equity investors are also much more sophisticated, and they're much better at being able to author investment terms that favor them even if something goes wrong. So with a venture investor, you may be arguing, as you see at the bottom row here, how much money are you going to invest and what % of the company does it buy? With a growth equity investor, there are likely to be strings attached. One of those might be, well, I'm going to invest $30 million and buy 15% of the company, but when the company gets sold, depending on the price, I want to get 3 times my investment, so $90 million back, before anybody else gets anything. Now that's called a preference, in this case a 3x preference. They might even then say, and after I get my 3 times, I want 15% of everything that's left over after that too. That's called participation. You're unlikely to see those terms in a venture deal. You are pretty likely to see them in a growth equity deal. Your mission when you are equity financing your startup is to make sure the valuation of your company always goes up at every round. You want to do that for 2 reasons. One of them is that every time you raise money, you dilute yourself. The later stage the company, the more money you're likely raising. So you need the price to always get higher so that taking on bigger amounts of money doesn't dilute you infinitely. But there's a second reason that applies only to you. When professional investors buy shares in a firm, they typically buy what's known as preferred stock. And that is what it sounds like. It's stock that has special rights and preferences above and beyond others. The management team and the founders typically own what's called common stock. Now, the preferred shares over here typically have what's attached to them called an anti-dilution clause. And what it says in brief is that if the company's valuation ever goes down, so you raise money here, then at this valuation, then here, but then you had to raise down here, right? That really dilutes everybody. But these guys get extra shares minted out of thin air that at least partially makes them whole. The common shareholders, that would be you or me when I was an entrepreneur, don't get that protection. So in one of these rounds where you raise at a lower price, what's called a down round, you get whacked twice. Once by the dilution, but then a second time by the anti-dilution provisions. Now there are some successful companies that avoid this. This is a chart showing you the share price, which is a proxy for valuation, of the biofuel company Gevo every time it raises money. Always went up, right, all the way to the IPO. Incredibly well executed financing strategy. But this is A123 Systems, which also had money going up, share price going up every single time until they thought they were going to go public. They weren't able to do that. They had to raise additional money to cover the losses in the business, then made a second successful run at an IPO. But that last time they raised money, it was down about 1/3 from the previous price. That would have been very painful for the management team and the founders who held common stock. All right, that's equity. Now let's move on to revenue. We're going to talk about 3 sources here that are very diverse, the first of which is cash flow. So this is people paying you money for something that you sell them or something that you do for them. I think you can probably imagine what the challenges of cash flow financing an energy or environment startup are. Let's say that you're going to make a desalination membrane, right? And at some point, you will be able to sell the membrane for more money than it cost you to make it. You'll take the gross profit from that sale, and you'll use it to grow the business, to start the next product or hire the next engineer. The problem is that you can't access cash flow funding until you've already built the product and gotten the customers, and that's what you need the money to do. So cash flow financing is the best source of money for your company, but it's often very delayed until you can access it. There are some exceptions. We're going to go to one exception at the very end of this talk and some examples. I had one of these exceptions in a previous life where I was leading an information services business focused on energy and environment, but that sold data and advice on a subscription basis. And we could get customers to sign up for a subscription and pay us on net 30-day terms for something we would deliver over the course of a year. And as you can see, if you could get enough of them to sign up before you started really delivering the product, you could completely finance it before you incurred any cost. Otherwise, won't talk much about cash flow financing. It should be pretty straightforward. The second I also won't talk about much, grants, because we are, after all, at an ARPA-E conference, implying that most of you know a lot about this financing mechanism, more than I will ever know. You understand the program managers on the other side of the table. You know what motivates them, how you write a great proposal and you quibble over project scope and milestones. So I won't go into that into detail. I will, however, spend some time on NRE. Can anybody say what that stands for? Yes, non-recurring engineering services, which is what it sounds like. It's money you get once, not for making an object, but for performing a task, for doing a service for someone else. An NRE is taking money from corporations, generally, to make something for them based on your technology. And for the making, you're going to get a fee as opposed to just earning their trust or something else. Let me give you an example of this so you can have an idea of how it can go right and can go wrong. So there is a company that we're very close to at Venrock. It has a platform technology that's applicable to a lot of different markets. And they have a very clear strategy that is to start threading the needle through market A, build customer-based revenue and cash flow in that market, and then expand to B, C, D, and E in years down the road. Now, a company came to them, a corporation, and said, hey, we're actually interested in your technology now for application D. So although it's not what you're doing right now, we'd like you, and we'll pay you to do it, to develop a version of your technology oriented toward our application and do that now, and we're going to pay you $2 million over the course of 18 months to do that. Now, as you can imagine, the CEO and the management team considered this in great detail. Now, that's $2 million with all of the accompanying dilution at an early stage when you get diluted by a lot that they're not going to have to raise from equity investors. Now, because we've already invested, we're aligned with them. We want them to get non-dilutive financing as much as they can. We get diluted too. Then what happened, they decided, okay, we think we're going to go forward. They had a series of negotiations with the corporation over months. And it resulted in, I don't have it with me, but this 20, 25-page document, page after page of legal clauses, of definitions, scope, terms, milestones. The CEO spent many meetings on this. The technical team did as well. And you know what? By the time they got to the end, they decided, man, we can't agree with this corporation about two things. About, on one hand, the IP rights that would come. Would they co-own this invention with us? Or do we own it by ourselves? And then secondly, about the exclusivity. They want it to be exclusive for them for 20 years. We don't want that. We want it to be able to sell it to another company in a year or two, max. And it ended up being probably, not a constructive use of time to go down this NRE road. So that's what can bite you. There's a lot of money available here. The aerospace and defense contractors like Lockheed Martin are the world's biggest providers of NRE, but oil companies do this, incumbent technology companies do this. You're typically dealing with somebody in innovation or product development who's trying to solve a problem, and they think they can solve that more cheaply and faster by having you develop your technology for it than by doing it themselves. There may also be kind of nefarious motives. They may want to stay close to you to keep tabs on you. If you compete, they may think it's better to know more about you rather than less, and if the price of that is $2 million, awesome. The key to the heart is having a great technology and exclusivity. But you're going to argue. You're going to argue over the scope, the milestones, their IP rights, the exclusivity, and it may not pay off. I think you can see from that example, it really applies to all of these. Your revenue financing mission is don't get distracted. So if a government agency is willing to write you a grant for something that is your business plan with no modification, awesome. Take that money all day long. If it's a grant to do something that's kind of peripherally related to the mission, it brings you some money, but it doesn't help you develop your product, you should be much more cautious. The same thing applies to NRE or to selling someone a product, cash flow financing, that is not what you're really trying to accomplish in the business. Third and final category is debt. Debt comes in many forms. We're not going to cover them all, but I'll go through a couple, and we'll take it from there. So let's say that you're going to buy a house. You're going to get a mortgage, right? What is the bank's security on that loan? If you can't pay, what do they get? The house. Absolutely. So for each of these three forms of debt we're going to talk about, there is a different type of security. And the first one is the one where the security is least obvious. It's venture debt. So you're an early stage startup company. You are maybe even still ensconced in a university, or you've just moved out and are in a lab somewhere. You have no assets, so there's no equipment to take away if you can't pay the loan. And you have no purchase orders, so there's no customer that the bank can get in between them and you and take the checks if you can't pay. How on earth could you get a loan? Well, that is what venture debt is actually designed to do. It comes from specialty debt providers, people like Silicon Valley Bank and Comerica. Some big banks do this as well. Wells Fargo recently re-entered this business. You're dealing with a banker, and like all forms of debt, they are interested in profit and profit and profit. That's the point. If you've ever been on the sort of loan officer side of things or known people, you would know that you don't maximize your returns as a banker by negotiating the best interest rate or whatever. Those are really market-based, and you have to conform plus or minus to what everybody else offers. You make money by managing the risk of default. So you're trying not to lend to people who have a high default risk, only to lend to people who have a low one. Wow, that sounds like a good room. Venture debt providers get through this in a non-obvious way. They only lend to startups that are backed by institutional venture capital. So the idea is the startup's unlikely to fail because the VCs won't let it fail, and therefore we're likely to get paid back. The venture debt providers, they want to profit. They also want your banking business, so they want you to put your deposits with them. They'll use that as their source of cash to make loans to other companies. And you'll argue about the interest rate, about payment terms, also about something called warrant coverage. So venture debt lenders will get warrants. They're like stock options in your company. They'll come to them essentially for free with the loan. If your company fails, they'll never be worth anything. But if you end up being Facebook, those warrants will be worth a lot of money. And unlike the equity investors who paid money for the stock that they'll get to sell, the venture debt players will get it for free. Next one's a working capital line of credit. Wow. Let's say you're in the light bulb business. You get a 1 million bulb order. They're going to cost you $2 million to make. You're going to sell them for $4 million in 6 months, right? Because that's how long it's going to take for them to get made, to go across the river on a boat, and then to come off the boat and get sold in Walmart. It would be very silly for you to go out and raise $2 million of dilutive equity financing to be able to pay for making 2 million light bulbs and the parts that go into them, right? That'd be crazy. You're going to have the $4 million later. You have a hard purchase order. You're just only going to have it in 6 months. That's what a working capital line of credit, often called a revolving line of credit, hence the picture, is designed to do, to provide you with a cash reservoir you can draw on. You can just keep dipping into it and paying it back, dipping into it and paying it back, to cover these ups and downs in cash flow. Specialty providers do this, big banks do. Unlike venture debt, there's no warrant coverage. There aren't any covenants where if you don't maintain a certain bank balance, you can't draw on the money. It tends to be much simpler, and the lending rates are usually described as an uptick on the prime rate. There are lots of other forms of debt. There's equipment finance, where someone loans you money to buy an NBE machine or a TEM, and their security is the machine. Often, in many cases, the vendors themselves will arrange this financing so you can buy from them. There's project finance, where you pay to deploy your technology in some scheme that has recurring cash flow, like a IPP type payment. And you're going to get that on a recurring basis. People arrange it. There's long-term debt, which is like the mortgage on your house. It's just a mortgage on a factory. I won't go into these in detail. The key thing to point out about all of these classes is that they really are straightforward debt investments. They're like the mortgage on your house. Your mission with debt financing, and this is a little controversial. It's not the standard answer you'd hear on debt, but it's Matthew's point of view, and I would feel that I was acting inappropriately if I wasn't honest with myself in speaking with you. I exhort you not to take on debt without cash flow. Particularly the venture debt providers, debt will be positioned as, well, it's a way of you managing ups and downs of your cash requirements before you have checks coming in the door. You can use it to optimize the time you raise equity. In the 2 years and change that I've been in Venrock, I've seen debt to companies without purchase orders and cash flow go wrong easily 10 times more often than it goes right. There are people who thread the needle and make it work, but there are rare exceptions. You would not buy a house and take out a mortgage if you didn't have a job. I exhort you not to take on debt unless you have cash flow. Last thing to wrap up, I wanted to give you 3 examples of real companies and show you what sort of financing approaches they took over time. First is a company called Energy Recovery, Inc. They make pressure exchanger systems that reduce the energy requirements of reverse osmosis. Founded in 92, went public 16 years later, so a long journey. The business was primarily funded by revenue, so even a few years in, they had $3 or $4 million of revenue a year, and they had about $1 million of profit, and they used that small amounts every year, sort of bootstrapping the business into a public company. They did take some equity financing, but it was not from institutional investors, only angels. It was $24 million, but over 14 years, so less than $2 million a year in equity money. They did take on some debt, but only about $4 million in a revolving line, and then one time took on a $1 million equipment loan. So this is an example where the time frame from inception to outcome was quite long. You didn't get to eat the pie for 16 years, but by the time you did, you probably had a bigger slice than you would if you had taken a lot of institutional equity financing. Second one, Solazyme. This is an algae oil and biomaterials company, 8-year time frame from founding to IPO. Primarily funded through equity and $128 million of it. That actually is close to the average for venture capital and growth equity money that goes into energy companies that have gone public. It's sort of right at the mean. They did take some revenue funding in the form of a grant, a $22 million DOE grant to build their first integrated refinery. They did thread the needle on debt in a way that I exhorted you not to. So in 2007, 4 years into the business, they took out a $5 million long-term loan. It was at almost 11% interest, so it was very expensive money. Was paid off a few years later, largely through some financial chicanery that I did not completely understand when I read their S1. But hats off to them for getting under the debt. Lastly is Tesla Motors. You probably know this company. How could you not? Similar 8-year time frame, so you're seeing this sort of standard number with equity-backed companies, institutional equity, primarily funded by debt in the form of a U.S. government loan for almost $500 million to build their first big manufacturing plant. They also took on equity, and a lot of it, almost 3 times as much as the typical company in energy and environment. But they were also substantially funded through revenue. Because this is the rare example of a product category where you could get people to pay you up front at least some of the purchase price of the car months or a year before they got it. And Tesla did that very successfully with the car you see in red there, the Roadster. And when they announced the Model X you see in the lower right, just last week they announced $40 million in pre-orders in 24 hours. That's all money that did not have to be raised non-dilutively and that you don't have to pay back. So hats off to them. That's everything. I realize this has been drinking for a fire hose. I don't think we have time for questions at this point. I'm going to be around here for the rest of the day today and all day tomorrow. Please reach out to me with any questions or thoughts you might have. Would love to talk to you about these things. And thank you for being here at the event.